Day weekend, and you're ready to hit it again. So if you have any questions, any concerns, please put them in the chat box or question box. We'll be happy to talk about them. Otherwise, today I want to talk a little bit about what's going on in the marketplace. So I'm going to watch a little video here. So there's a bunch of grizzly bears fishing for salmon. Oh, fish jumps right up onto the fisherman's going to take him on. He wants that fish for himself. They're having at it. Boom. So how are we going to defeat the bear? So how do we defeat the bear? And why is that even necessary to talk about the bear right now? Well, here's the thing. The reason, I don't know if the bear is around the corner next week, next month, next year, but why is, let's see some questions. Why is it a concern? Why is the bear market, or should the bear market be a concern? Because none of us has a crystal ball when something's going to happen, but why should it be a concern? The screen should give you a hint. Don't want to lose money. I agree with that. People get complacent. I believe with that too. Very high. Trees don't go to the sky, Charles. That's what I'm looking for. Trees don't go to the sky. This thing is old. This bear is old, old, old. Fourth oldest since 1900. So that means, you know, we don't know if it's gonna, when it's gonna go, but we do know it's very old. So I want to talk today about some of the things that you guys can track to give yourselves an indication of if, you know, of when the market is going to turn. There are some things that you can look in the future and give you indications that, things are not good. So I'm going to throw some of those at you because, you know what, this will help you when you're talking to your, first of all, helping manage your clients' money, but second of all, when you're talking to clients, to make sure that they know you know what you're talking about. So first of all, when we look at the bears, this is the last two stock market crashes compared to the garden variety bears. So you see the mega bears versus tamer bears. So the duration of a tamer bear is 12 months, and it takes 11 months to get back to ground even. So I'm going to tax your math skills here. So in a tame bear, how long does it take to get back to ground even? We'll see how good your math skills are. It says time to get back is 11 months, but is that really how long it takes to get back to ground even? Ah, very good, John. John said 23 months. You got to add these together. So basically, during a tame bear, it's 2 years. Now, let me ask you a question. 2 years when you're 25 versus 2 years when you're 45 versus 2 years when you're 65. Are they the same 2 years? No. Why aren't they? I'm getting a lot of no's. Why are they not the same no's? I'm sorry, no's. Why are they not the same 2 years? It's a huge difference, Matt. I would agree. Yeah, you don't need income now, Victoria. You got a little, your time, you know, time starts to squash when you're 65. Yeah, the can't recover. So that is along. Now on the mega bears, look at what happened. 26 months in a bear, 69 months to get back to ground even. So now how many months did it take to get back to ground even? What do we got? 80, 90 months. So that's, how many months is that? Or how many years is that? 95 months, which is how many years? It's a lot of years. Now, how does that compare to somebody who's 25 or somebody who's 45 versus somebody who's 65? Somebody who's 65, that is what? That's brutal. That is brutal. Because they're now what? 75. And are you physically different when you're 65 versus 75? See, if you tell somebody to wait for 7 or 8 years when they're 65 before they start to spend their money, you know, knees go out, hips go out, energy levels get lower. So they can't do the things that they want to just 10 years before. So it makes a big difference. Now, it's here, losses from peak to trough. 2000 bear was 56, 2007, 2009 was 49. A tamer bear is 27. So let me ask you a question. Why are we seeing bigger swings than we have on average over the past 100 years? Why are the swings bigger? The last two bear markets have been huge compared to the average bear. Why are we seeing those bigger? The media, Jeannie, I would agree totally with that. Fed intervention, I agree with that. Technology, all those things, media, technology, computer programming. It's all of those things. So do you think that going forward, our bears are going to be tamer or grislier than they have been in the past? For all the reasons you said, Fed intervention, media, technology, computer buying, they're going to be worse and longer. That's just the way it is. So with the fourth Otis bull, stocks are getting expensive, profits are slowing, and sooner or later the Fed is going to have to raise interest rates. So again, we don't know if this is going to turn next week, next month, next year, or next decade. There's no guarantee of when we're going to, but we have to be aware and start to look for the warning signs of a bear. So that's what I want to talk about today. So what are the warning signs? Well, one of the ways you can look at it is the law of supply and demand. And I want to thank Tom for this. Tom sent me this research from Lowry Research. I think it's awesome. Lowry has been around since 1925, and they've been measuring unbiased forces of supply and demand since then of the New York Stock Exchange. So changes in buying enthusiasm, the desire to sell, provide progressive warning signs. This is important. Now, why is this important? Why is it important? Guys, what has the same thing caused any of the bear markets in the last 100 years? Has it been the same thing that caused anyone? Has there been one cause that has been twice the cause of a bear market in the last 100 years? Roy says, no, I agree. There's no. It's not the same thing. It's always something different that causes it. Because if it was the same thing, guess what we could do? If it was the same thing that was causing bear market, yeah, we could predict it. But instead, does anybody ever predict the bear market? No, until afterwards. I mean, does everybody say, oh, this is why the bear market's going to occur? Does anybody say, this is why the bear market's going to occur? No. Instead, what do they do afterwards, after the bear market is done, then we got all sorts of geniuses telling us what? What are the geniuses telling us after the bear market? Yeah, Harry Dent, he's always wrong. There's a lot of guys that are always wrong. So what is all hindsight, Paul, exactly. Steve's saying, yeah, I told you this guy was falling. Yeah, they always say it after the bear market is done, because if they were really geniuses, when would they tell us? They tell us before, not after. It's all hindsight. See, and here's the really hard thing. It's always brightest before the storm. What do I mean by that? What do I mean it's always brightest before the storm? Yeah, we're always reaching new highs, Roy. It never looks like a fall, man. Right. So things are usually just beautiful, beautiful. The market's good and setting new highs. Everything's going great right before kaboom. Kaboom. So this Lowry Research had an excellent analogy for figuring out when the bear market is going to occur, and they used the fall before winter. And here's the point that they made with the fall before winter is that fall creeps up on us, doesn't it? How quickly do the leaves change? Overnight? How quickly do the leaves change? And do all the trees change at the same time, or do trees change at different rates? Slowly, and every tree's a little bit, right, Lyle? Slowly, everything's a little by little. And then do the leaves fall off the trees all at the same time? No, and in fact, some days you're wondering, look at all the leaves on the ground. How did they get there? Because I haven't seen a single leaf fall. And here's their point. I think it's brilliant what they're talking about. See, the market is made up of 40 to 50% small caps, 30 to 40% mid caps, and 10 to 15% large caps. But what is the market? What is media always reporting? What does media always report? What are the big, or what are the large, right, Roy? The large, the Dow, the big guys, right? So here's what they've looked. When they've gone back to 1925, so 85 years or whatever of watching this law of supply and demand, what they found is that the small caps start to fall first. But do we see the small caps falling? Are they in the S&P 500 or the Dow Jones Industrials? So we don't see them falling. Yet but they're falling, and it's 40 to 50% of the market is falling, but we don't even see the market is going down. And then after the small caps, the mid caps follow. Are mid caps in any of the big indexes that we watch? No. So then they start to fall. And then and these two, the small caps and mid caps, are falling at the same time. The large caps are hitting new highs. So everybody thinks what? And this is a hard time to be an advisor, right? This is a hard time to be an advisor because you have your clients in small caps and mid caps, and they're seeing their accounts go down at the very time the market's going up. So how do you explain that stuff? That's a tough row to hoe. But that's a good indicator of, oh my gosh, things are starting to have problems here. See, when you can tell, and again, I think this Lowry research is awesome because it only makes sense, guys. When the market, when people no longer want to buy stocks, guess what's going to eventually happen? The prices have to fall. So small caps and then mid caps begin in downtrends at the very time the S&P 500 and the Dow Jones Industrials is hitting all-time highs. It's really a sucker punch, isn't it? Because everybody's thinking, oh my gosh, everything is going great. And then they think, whoa, how did this happen? Lucy pulled the ball up. How did this happen? No. It was happening right in front of your face. It was right in front of your face. So here's some of the things that they look at. During the beginnings of a bull market, guess how many stocks are hitting 52-week highs? Most stocks are hitting 52-year highs. Yeah, that's right. The soldiers, Charles said, the soldiers are leaving the battlefield while the generals are sticking around. Exactly right. So during the beginning of a stock market high, or stock market or bull market, most of the stocks are hitting new 52-week highs. But what they found is that about between 6 to 12 months in advance of the peak of the S&P 500, the peak of the Dow Jones Industrials, you'll start to see more and more stocks contract. More or less stocks are hitting 52-week highs. They start to trend downwards. The big guys, the S&P 500, are still hitting 52-week highs, but the mid caps and small caps are starting to put distance between themselves and their 52-week highs. So that's what they're watching, and I think it's a brilliant thing to watch. Also, what they're looking at is, again, where people are, up here, people are still, instead of selling, I mean, all the mid caps and small caps are selling at the same time as the, so they're moving down here at the same time as the S&P 500 is going up here. So you got to be paying attention to that. You can also look at the advanced decline line. So you should never make your total decision on the advanced decline line, but you should be paying attention to this. And when it gets weaker and weaker, you need to be paying attention, because when more stocks are declining than advancing, guess what? When more stocks are declining than advancing, you got problems. You got big problems, right? So here's a couple indicators. We got the 52-week high. How many of them are near the 52-week high versus putting distance between themselves and the 52-week high? And the advanced decline line. How many? What's that looking like? Is it turning towards the south, or is it still strong going north? Are there more stocks hitting advancing versus declining, or vice versa? And again, you won't see this because the only things that they're looking at is the market media is the S&P 500 and Dow Jones. Also, here's this has been around forever. Looking at the big indexes as compared to the smaller indexes. What they used to use was the Dow Jones Industrials compared to the Transportation Index. But now there's so many other indexes out there. What you want to look at is when the big indexes, the S&P 500 or the Dow Jones Industrials, are hitting new highs, is that being confirmed by the lesser indexes or the less popular indexes? If you find the less popular indexes are trending downwards at the same time the S&P 500 or the Dow Jones is hitting highs, this again is a warning signal. A warning signal. So Gary said, talking about the golden, or not the golden cross, but the death cross, which is when the 50 falls below the 200. What Lowry uses is a 30-week average. So when the market falls below, when the 30-week average, when you map that out, the moving average trend line, and when the market falls below that, you got problems. And again, unfortunately, what you're seeing is it's near new highs. And just look at this graph for an example here. You got it goes up, it hits a high, goes down, comes back up, hits that high. So obviously things are okay. goes down, oh, it's coming back up again before it takes off in a big downward. So as soon as it goes below that 30-week average, that moving trend, you need to be cautious of that. And when it bounces off the top of that, that's when you've got really problems. Not when it bounces off the bottom here. See how it's bouncing off the bottom, bouncing off the bottom. But when it goes up and it can't make it back through, and then it bounces again and then goes down, you got real problems. So are these things that you're watching? Now here's the thing that Lowry's found, is that most money managers don't look at this. Instead, they're looking at things like, well, I won't get into that whole thing. That's a whole different talk. Now, buying power versus selling power indexes. There are two indexes, buying power versus selling power. So during the beginning of a bull market, there is zero seller, very, very low selling pressure and huge amounts of buying pressure. At the peak, you start to see it even out, and then it starts to trend where the selling pressure is high and buying power is low, which means that you see the spreads, the spreads between buying power goes up and up and up because nobody wants to buy, and the selling pressure goes down, the spreads get lower and lower and lower because everybody is selling. So that's another thing that they look at. So with that, they're looking at, if I can let's find it here. Aha. Oh, and I'm sorry, I'm going to go back here. I forgot to talk about this 30-week average. They said that basically they found that during healthy bull markets, 75 to 90% of stocks are above their 30-week average. During a healthy bull market, 75 to 90% of the stocks are above their 30-week average. But as soon as you get to below 60%, when 60% or more are below the 30-week average, you need to run for the hills. Run for the hills. Now, here's the real problem is this, is that everybody wants to say what? This is why, in a nutshell, why money managers don't look at this law of supply and demand. Guess what they say? This time it's different. This time it's, no, I understand the numbers, but this time it's different. Because they have to say that. Why does Wall Street have to say that? Why do money managers have to say that? Why do they have to say that? Why do money managers and Wall Street and mutual fund managers, why do they all have to say that this time is different? Even if they're seeing these things. Well, to look smart, I think it's, Barry's got it, to keep people invested. If your money manager moved all the money to cash and they're still charging a fee and the market goes up another 10 or 15%, because do we know when the bear market is going to occur? We don't. I mean, if we go back here, oops. So what if, can you see my arrow here? So what if the, what if the money manager said, you know what, I see it's struggling to get over the 30-week average line. We need to get out. I'm moving to cash. And he'd look brilliant here until the market goes back up here, and then all of his clients are going to say what? What the hell? We just missed what? We went from 8,000 to 9,500. That's a huge increase. Why were you out of the market during this time? Now, he was smart because he saw that it was having trouble, didn't reach the high. So he sees this indication, it's having trouble making it. So it's very, very difficult for a money manager to get out of the market. It's very difficult for Wall Street, and they've looked at this. How many buy recommendations does Wall Street have during the best? Let's talk about even in the highest level of sell recommendations versus the buy recommendations. What is the highest level of sell recommendations compared to buying recommendations? When has that ever occurred in Wall Street with Wall Street analysts? Guess what they find? When do they ever have higher sell recommendations than buy recommendations? Has that ever happened before? Never. That's right, Tom says never. Never, 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 never. The buys are always astronomically higher than the sells. I don't care where it is. Bull market, bear market, bottom of the bull, bottom of the bear, top of the bull, doesn't matter. There's always tons of buy recommendations and never sell recommendations. Why? Because they don't make money when you're sitting on the sideline. I mean, Upton Sinclair basically said it's difficult for people to have good judgment when what? It's very, very difficult for people to have good judgment when what is involved? Think about, when their income is involved. And that's what we find. So this time is different. There's always people saying this time is different. But sorry, I mean, supply and demand, it's the law. It's not the suggestion of supply and demand. It's the law of supply and demand. So what should you do? Run for the hills? No, you got to keep calm. But let's be serious. How you invest in the 7th year of a bull market has to be different from how you invest at the beginning of a bull market, doesn't it? So can any of us see the bear coming? I'm not sure. I think you could see the bear coming, or you might see signs of the bear coming. We certainly don't know exactly when the bear is coming, or we'd all be sitting in our yachts in the Bahamas at this point. So we don't know. But like we said here, doesn't it make sense to be somewhat cautious in the 7th year of a bull market as compared to at the bottom? So what can we do? Well, here's one thing that I looked at. Again, Halbert Digest. I love Halbert Digest because it looks at 2,800 newsletters. Now, here's what you have to understand. Do newsletters perform better or worse than money managers and hedge fund managers? Do newsletters perform better or worse than money managers or hedge fund managers or anybody who's actually dealing with real money? John says yes. They're better. Why do they perform better? They always, no bias. I thought it's theoretical. Yeah, I would guess. And what you mean by that is they're not using real money. That's right, Barry. They're not using real money. So these advisors always perform better than money managers because they're not using real money. They don't have to deal with people pulling money out and having money in cash. For people that are pulling money out, they don't have to deal with how things are reflected when you buy too much of a stock. I mean, so they're always going to do better. So they should actually be doing better than the average money manager. So what Halbert is just awesome at research. So what he did is he said, well, how can we, if we knew the bear was coming, first of all, we have to know the bear is coming, but we don't know the bear is coming. But if we knew exactly when the bear was going to come, who should we invest in? Who would know better? Who would know what to invest in if the bear was coming? So what he did is he looked back and said, well, what if we did this? What if I went back and found the newsletters that performed the best during the 2000 to 2000 bear market? What if obviously if they did great during the 2000 to 2002 bear market, they must be what? Awesome at managing bear markets. So these did what? Look at, they made 10%, 6. When everybody else was losing 60%, they were making money. That's awesome. So let's invest with them when we suspect the bear is coming, right? Well, if you would have invested with these top 10 who did the best during the 2002 to 2002 bear market, look at what would have happened in the 2007-2009 bear market. Down 40, down 40, down 10, down 40, down 18, down 8, down 35, down 40, down 50, down 15. An average down of 29%. They would have been in the 49th percentile, which means a full half, more than half of all newsletters would have performed better than you if you'd invested with these guys who did the best during the 2002 bear market. So does that mean? So what does that mean? Can we go back to somebody who said, "Hey, I did really well in the last bear market"? What does that mean? Yeah, it's luck, John. Exactly. So just because they did well in the last bear market, does that have any indication of how they're going to do in the next bear market? Zippo. Nada. So do you guys understand why I get irritated when I'm talking about money managers who say they're going to, we can protect you on the downside and still get you upside? Guys, can anybody do that? Nobody can do that. Nobody. So Halbert, what he looked at, said, well, maybe this isn't the indication. Maybe I don't want to look at people who are just good at bear markets. Maybe I should go back to the last 15 years and look at who was best overall, who had the best beta, who had had the least amount of risk for the most amount of return. Least amount of risk for the most amount of return. So what if I went back over the last 15 years, used a Sharpe ratio, had the lowest risk involved. So he went and looked at the 10 newsletters again, and we said newsletters perform better or worse than money managers? Better. So these should look better than any money manager out there. Just like these should look better than any money manager out there. So if these guys can't do it, guess what we know? If these newsletters cannot do it, guess what we know? If the newsletters cannot do it, what do we know? Because they're not dealing with people cashing in money, dealing with all the things that a manager has to do, taxes, cashing in money, having too much money weighted on one stock. They don't have to deal with any of that. So if these guys can't do, nobody. So they couldn't do it here. And then if you looked at the managers who had the least amount of risk over the last 15 years, hey, let's look at them. Well, guess what? How they did during the 2007, 2009 bear market. Again, down 40, 38, 32, 41, 50, 39, 27, 33, 33. An average loss of 33%, which they were only in the 41st percentile, which means almost 60%. Almost 60% of stock or of managers beat these. So wait a second, I'm confused now. These are the guys that are best for risk. These were the guys that were best over the managing a bear market. Why are they performing at below average? Why are they below average? Why are they below average? Got all the money in at the wrong time. Yeah, I mean, there's lots of. Here's the main. These guys are whiffing. Let me see here. Tom said because they don't know any more than you. Different scenario, Paul. Exactly. It's so difficult because as we talked about earlier, every single bear market is what? What causes every single bear market? As Paul said and Tom said, it's a different scenario. No one knows. So the guy who's watching the curveball gets hit by a football. He's watching for the curveball in the baseball game, gets hit in the head with a football. And the guy that's watching for the football gets hit in the back of the head with a lacrosse ball. And the guy that's watching for the lacrosse ball gets hit in the nards with a soccer ball. It's always something what? Different. So it's impossible. Guys, if it's impossible for these guys to prepare for a bear market, what do we know about money managers? They cannot do it either. So what's our solution? Somebody said it really early on. What's our solution? 50-50. 50-50. Because why? Because when we tell people they're in the market, we don't make promises we can't make. So we tell them, hey, this money's in the market, and when the market goes up, it's going to go up, and when the market goes down, it's going to go down. The good thing about the market is 70% of the time, historically, it's gone up, and 30% of the time it's going down. So what we want to be in there is all the time, so because we never know when we're going to have a 70% here or a 30% here, so we have to be in there. We have to be in there all the time so we can participate in those good years, and we know there's going to be down years. That's why we have this 50-50 over here. We have this 50% over here in guaranteed money. And heck, you know what? During good years, the guaranteed money is going to do great. During down years, you're not going to lose a cent, and it automatically buys low, sells high. Why do I like FIAs better than bonds? FIAs blow the pants off of bonds. Why? Annual reset, Barry, you got it. They automatically buy low, sell high. Do bonds do that? Remember about a month ago when Jeff showed even at a 50% participation rate, the FIA beat what? Over the last 10 years, the last 15 years, at a 50% participation rate with automatic resets where it automatically buys low, sells high, it beat what? It beat the market. It didn't beat bonds, it beat the market. It beat the frigging stock market. Now, we don't make that claim to anybody. We don't make that claim, but Jesus, criminy, if it's going to beat the stock market because of that buy low, sell high, automatic reset at a 50% participation rate, that's a great place for your guaranteed money. And if it's going to beat the stock market, it's going to crush bonds. Make sense? So do you get why I love the 50-50? I've been using that. Guys, do you think I'm an idiot when it comes to investment theory? Do I know as much as anybody else when it comes to investment theory? Hey, Missy, can you find out when Jeff did the coaching call with Jeff's 50%?
I sure will. Yep.
Thanks. So, guys, am I an idiot when it comes to investment theory? I mean, I read a lot. I'm not an idiot. So, and yet, for the last 20 years, guess where my money's been? In the last 20 years, guess where my money's been? 50-50, 50-50, 50-50. Because you know what I know? Tom said it perfectly. I'm not a genius. I'm just common sense. I know what I don't know. And you know what I don't know? I have no clue what's going to happen tomorrow, next week, next month, or next year. So if I got 50% of my money guaranteed in a place that performs well, then I can afford to have 50% of my money shooting for the shooting for the stars. Does that make sense? Can you hear me, Missy?
Yep, I sure can.
Okay, I just had a couple people say no sound, so good. So that's any questions, concerns about what I covered today? That's all I got for today. That's bullshit, Matt. Call me after this. I'm going to tear you a new one. 50% of equity outperform FIA. Yeah. 50% of, no, the FIA at 50% comparison, at 50% participation rate beats the market. And did you find that, Missy? The coaching call?
I'm still looking for the date on that, but I will we'll send out a note with that.
Okay. John's saying at 865 should you be even a little bit more. Well, remember the 21-point checklist? Do we ever tell them what they should be in? The 20-point checklist, do we ever tell them what they should be in? No, they tell us. It's designed for them to tell us where they want to be. Now, in 15 years of doing it, Jeff Freeberg, 15 years of doing this, can you get on there, Jeff? Since you handle most of the 21s or helping guys.
Yep,
21s.
I'm here.
So in 15 years of doing this, Jeff, how many people, how many 21s have we ever done where the people have wanted more than 40% of their money in the stock market?
It's very rare. It's very rare.
What's very rare? How many times in a year?
Maybe I could count on one hand in a year.
So that's compared to what, 1,000?
Yeah, yeah. Over the thousands. What happens is the place where this comes up is investment weighting. So when you're talking about investment weighting, what we tell people is, everything in life runs on a bell curve. So just as an example, let's say we had 100, and then you use their age, 65-year-olds running in a race. Well, some of them are going to finish really, really fast. That's up here on the bell curve. Some of them are going to finish really, really slow. That's the back here on the bell curve. Where are most people going to finish? And they say, well, yeah, in the middle. Yeah, in this big herd. In the middle. That's why there's that big bulge, because most people are going to finish in that herd somewhere in the middle. And then we walk them through how investing is really kind of the same. Some people are really fast, and we give them an example, a kind of a ridiculous example. Some people, they're really fast with their investing, so they'll take their Social Security check, they'll run down to the Indian casino and they'll gamble it, because everybody knows you can double your Social Security check overnight at the Indian casino. Now, that's really fast. Some people are really slow with their investments. They'll take their money, they'll put it in a mattress, they'll bury the mattress in the backyard. But where are most people? They always say, oh, in the middle. Yeah, so kind of where do you see yourself? Well, in the middle. Now, why do they choose the middle? Because are they going to say they're the people that bury their money in the mattress? Probably not. Are they going to say they're the ones that take their checks down to the Indian casinos? Probably not. I've actually never heard that on a tape, to be honest with you. I mean, I've never heard that, not even one time. I've heard people say, I want to be more aggressive. I've never heard anybody say, oh, no, I want to take my check to the Indian casino. So they're always going to tell you in the middle. Now, then we walk them through, what does the middle mean to economists? And then we ask them, that's economists. That's their number. What's your money? What's your number? They're always going to come in right around there. They don't deviate much from that. Why? Well, because they just told you how many times we're in the middle, we're in the middle, we're in the middle, we're in the middle. They're not, at that point, after telling you they're in the middle 5 times, going to tell you, no, we're the outlier. They just don't do it. Do some people do it? Yeah, 5 in 1,000.
Yeah, exactly. And Tom just, in 15 years of doing this, I've never met anybody who does more research or thought than Tom and Colin. And he said he went back and actually did his own analysis for last 25 years, and the FIAs would have for the last 25 years made 8.76% versus 6.76 for the market. And over 25 years, that would be $200 on a $100,000 investment would be almost $222,000. I mean, and guys, but it doesn't matter what that's huge numbers. But push comes to shove, what it comes down to is we need 50% of the money in What? Guaranteed. That's why when Matt says, oh, it doesn't include dividends, blah, 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 blah. What the hell? What is he thinking when he starts to do that kind of argument? What's he thinking, guys, when he makes that kind of argument? That's right. Are we saying that? Am I saying that you should put 100% of people's money in the FIAs? No. So why is he making an argument about that? Why is he making an argument then about the fact that, well, you know what? Oh, FIAs don't include dividends. Because he's comparing it to what? What's he comparing the FIA to? The market. Are we saying the FIA should be in the market? No, we're saying there is no better place. There is no better place for your guaranteed money than an FIA. Does that make sense? So, good. We don't know when the bear's coming. We don't know when the bear's coming. We don't know what's going to happen. But, guys, I don't care if we're at the beginning of a bear market. I don't care if we're at the bottom of a bull market. You know what I don't? You know what I know? I know what I don't know. I do not know what's going to happen next year. So 50-50, if it's good enough for a guy who knows what the hell he's doing, and I think I know what I'm doing. I mean, if anybody wants to go against me one-on-one, with the exception of Tom, anybody wants to go against me one-on-one on investment theory, I'd be happy to do it with you. And I tell you what, good luck. I think I know what I'm doing, and still I have 50-50 because you know what? I've been doing this long enough to realize I don't know what's going to happen. I can be the smartest guy in the world. Guy, if I'm the smartest guy in the world, does that help me when it comes to the market? No, because I'm dealing with what? I can be the smartest guy in the world when it comes to the market, and it will not help me because who am I dealing with? Millions and millions of what? I'm dealing with uncertainty, but if I'm the smartest guy in the world, I'm still dealing with who moves the marketplace, guys. Who moves the marketplace? No, not people smarter than me. People what? Dumber than me, Chris. What do you mean by that, Chris? You got it right, Chris. And yeah, average, man, I would agree with that. The herd. The herd. I'm dealing with the herd. I can be the smartest guy in the world, but me, one guy, cannot move the marketplace. The world moves the marketplace. The millions and millions of other investors out there move the marketplace. And guess what? They're not that bright. I'm sorry. You know what? And guess why I think they're not that bright? Because of what Rick said. Because they're emotional. Most guys most investors are not investing intellectually. And it's the herd that moves the marketplace. It's the herd that moves the marketplace. And the herd does not move based on intellect. It moves based on emotion. Even the smartest people in the world, when it comes to investing their money, do what? Even the smartest people in the world, when it comes to their money, do what? Get emotional. Yep, they get emotional. And when you make emotional bets in the marketplace, guess what? You're cooked. So I cannot bet against the herd. So 50-50 makes sense. Everybody good? Any questions?
And Michael, to answer your question about Jeff's 50% analysis call that he did, that would be April 6th.
April 6th. So that's when Jeff Van Grinsven went through and he actually has that software and all that stuff. So if you contact ECA, Jeff Van Grinsven or Jerry, they have all that information of the 50% versus the marketplace. And again, are we saying that that's going to beat the market? No, we don't tell people to put all their money into an FIA. We say put your guaranteed money there, and if it beats the equity side and it's still safe, hallelujah. But really what we're saying is it's going to beat the pants off bonds. Super. Thank you for being on today, and Jeff will talk to you on Friday. Thanks, guys. Have a great week. Talk to you soon.